This week in economics, numbers man here, 15th of February 2005. This will air between the 15th and the 14th, depending on which platforms we are broadcasting from. There's some problems now over at Stitcher, but nonetheless, we'll be there. We'll start with crude oil and a little study here. We'll talk about it, especially for the iHeart version, which this is a dual purpose this time around, but it'll be in that mold. It is by Nigel Cork and Jericho Tenon. It's called Falling U.S. Treasury Objects, and this is from the IMF, Direct International Monetary Fund's Global Economy Forum. It's a little blog here, and we'll give you the gist of it. Remarkable collapse in the price of oil, a key global price that is virtually in the space of a few months, has received a lot of attention. Meanwhile, another significant shift has taken place in recent months that is just as surprising and has wide-reaching global implications. The dynamic drop in long-term U.S. Treasury bond yields. The last time we saw the 10-year Treasury bond yield at this low was in May of 2013. As many will remember, and when it is corrected, it set off a burst of volatility across emerging markets. The sharp drop in key global interest rates has occurred despite the general strength of the U.S. economy, the positive news coming from recent data, and the broad consensus among analysts that today is soon approaching when the Fed will start raising interest rates. A term premium story. Once you strip out the changes in the expected path of future short-term rates, it becomes clear that it is the term premium, the compensation that investors receive from holding long-term bonds rather than rolling over a sequence of short-term bonds, that has been responsible for a chunk of the fall in treasury rates. The term premium has actually turned negative since the start of the year. Looking back in history, this is a rather abnormal occurrence. So what's going on? Well, likely reflecting a combination of factors. There are a number of candidate explanations. The disinflated vortex. Some believe that long-term inflation in the U.S. could become permanently stuck below the Fed's 2%. You've heard about the Fed's 2%. And the preoccupation with many of the economists and economic analysts with inflation. We at this mic have always said that is a misdirected fear. As a consequence, holders of long-term maturity bonds, would need less compensation for future inflation. Certainly, market pricing of inflation break-even has been falling, something that has been highlighted by the FOMC statement. However, we have our doubts whether the expectation of falling inflation are as a big part of the story. Survey data seems to show that inflation expectations have not moved much. Fear over greed. Increasing global risk aversion is another possibility with events in Ukraine, in Greece, and in the Mideast. Investors have decided to take risks off the table and are heading to the gold standard of safe assets, U.S. Treasuries. While this is likely part of the story, the current unusual low levels of Treasury yields still seem incongruent with market pricing volatility. A scarcity of safe assets, that is a very important point there. The recent improving fiscal position in some of the larger industrial countries, including the U.S., have reduced the net supply of global safe assets. At the same time, the largest central bank in the U.S., Japan, UK, and the Euro area have either bought or are intending to buy significant shares of their outstanding sovereign bonds. This implies a diminishing stock of safe assets left for private investors, pushing up bond prices and lowering U.S. yields along with yields in many other industrial countries. Still better than the rest, although the yields on U.S. treasuries have been falling, they're still a cut above what you might see elsewhere. Germany and Japan's 10-year yields are only 0.3%, which when looking at this from this perspective and adjusting for the sovereign risks, even shrinking returns on U.S. Treasury bonds don't look too bad. The strong dollar. The recent stellar U.S. growth performance is diverting from much of the rest of the world. It's not surprising then that investors would expect the dollar to continue to strengthen in the months ahead. Indeed, Secretary Lew, the Treasury Secretary, recently reinforced that view by saying, "I've been consistent in saying, as my predecessor, that would be Timothy Geithner, a strong dollar is good for the U.S. The yield differential mentioned above, combined with expected appreciation, should mean continual flow into U.S. dollar assets, which in turn will pull down pressure on the whole U.S. yield curve. Risk, yes. Conundrums, no. Some have argued that the falling long-term rates are set to follow the Fed's ability to control financial conditions and guide the economy to full employment and stability, a so-called Yellen conundrum. Far from being a conundrum, having long-term rates at relatively low levels may actually give the Fed more degree of freedom. The Fed can still raise policy rates even if long-term rates remain lower than expected. This would act as a brake on the economy through the efforts of the exchange rate. Interest rates on credit cards, floating rate loans, and equity pricing. However, at the same time, if long-term rates stay lower, this would help support the housing sector and large pieces that have yet fallen into place like a jigsaw puzzle. The inflationary pressures were to become more permanent, which we currently see as unlikely. The yield curve should steepen automatically to act as an additional countervailing force. If somehow the Treasury yields remain unusually low, though, the Fed could easily raise policy rates at a faster pace, returning to a neutral on a more accelerated timetable. Rather than being concerned right now about the positive monetary policy conundrum, What we should be weary of instead is rapid unwinding of falling term premiums, the way we saw them in 2013. We remember that. The market freaked out, I guess is a term, not very professional economic term, however. As a result, mortgage activity experienced a sudden stop, and residential investment stalled, and the negative consequences spilled into the global economy, and particularly into emerging markets. It's the old adage, if the basic markets catch a cold, the emerging markets catch pneumonia. Even though we find the recent low treasury rates could prove to be all too temporal, in the months ahead, we look back on this time with hindsight as a period where long-term rates transitorily overshot their fundamentals, rather than attach a warning sign to the conundrum of falling yields. We should be watching out for its economic and financial stability fallout that could unfold if U.S. yields snap back upward in a sudden and unexpected manner. We don't expect this to happen. What's becoming now what used to be an abnormal situation is now a normative situation. In other words, the markets have adjusted to that, and of course you talk about long-term bond yields. Many investors have went into short-term bonds, which basically says that they're in very short positions, and it is a wise thing to do. Usually what investors like to do is tie into a long-term situation. In other words, bondholders are bondholders. They're not in there for 3 to 6 months. They're in there for years. But there are very few other places for them, quote-unquote, to place their monies. So thus they stay where they are. Let's go to the rigs. This is from the Bloomberg news here. U.S. rigs are becoming idle, but the boom is not ending. No doubt about that. Drilling freezy is over. The U.S. drilling freezy is over, but not the boom in oil production. While companies have idled 151 rigs in 5 of the Slay formations since reaching a peak of 1,157 in October. They'll need to park another 200 for growth to stall, according to data. This is from the U.S. Data Information Administration. We've used their data before here. Output would reach a record 5.47 million barrels a day in March, even though the number of rigs exploring for oil is at the lowest rate since 2013, which was at a higher rate than the recent history of the U.S. Spending cuts lead to speculation that U.S. Gains would slow, eroding a global supply glut that sends oil prices tumbling last year. Oil has jumped 18% since closing at a 6-year low of $45.45. Not low enough. Improving technology, that is the key there, and a focus on more promising acreage has made rig count a closely watched barometer of drilling activity and a less reliable indicator of future output. No doubt, the trend, in U.S. oil production is the key variable in the oil market this year. Any sign of a greater growth engine is slow, is eagerly anticipated. As from Jim Burkhardt, he's at the Washington-based IHS global analytics firm headquartered in Inglewood, Colorado. There may be some false starts, and we may have seen one. The industry has become better at